Hello everyone and welcome to the lesson. We'll continue with the chapter, the financing decision. We've been studying the long-term sources of funds for organizations. Today our focus is on private equity. Private equity. We'll first define what is private equity, then we will highlight the characteristics, the benefits and the drawbacks of private equity as a long-term source of finance. So by the end of the lesson, you should be able to outline the characteristics, the benefits, and the disadvantages of private equity, which involves investments that are made by private equity firms or institutional investors into privately held companies, where privately held companies obtain capital from institutional investors or private equity firms. Then that source of funding is known as private equity. And these investments often involve taking a significant ownership stake into the company. It may also involve actively participating in the management and strategic decisions of the invested company. So when private firms, private equity firms or institutional investors put their money in a private company, such investors may actively participate in the management and the strategic decisions of that specific company. In this lesson, we are going to outline the characteristics of private equity. We begin with we are going to begin looking at the characteristics. We identify several characteristics. Then we look at the pros. We'll have pros. Pros and cons. We'll have cons on this side. You understand? Yes, we're going to have here, first of all, characteristics or features. What are the features of private equity? Features. Going to highlight the features like that. Now, the first feature is that one related to investment, equity investment. Equity investment. Equity investment. Equity investment. Now, candidates, private equity involves the purchase of equity. It involves ownership in a company, and private equity investors become shareholders, and as such they have what we call, they have vested interest in the company's success. That is one feature of private equity, where private equity firms invest their money in a private held company. Then they become shareholders. They become shareholders. They purchase equity. They become shareholders in the privately held company. Private equity. Equity investment. Now, the second feature is active involvement. Active involvement. Active involvement. Active involvement. Active involvement. What does that mean? Now, private equity firms often take an active role in the management and the strategic decisions of the companies that they invest in. And this involvement can include changes to the company's operations, it can include governance, it can include leadership, and so on. By the mere fact that they have vested interest in the company, and by the fact that the private equity firms have become shareholders, then one feature is active involvement. They actively get involved in the operations of the company, in making strategic decisions of the company, and so on. Active involvement. Next feature is long-term horizon. Long-term horizon. Private equity investments have a long-term focus. Long-term focus. And investors aim to enhance the company's value over a long period of time. All right? Over a long period of time before seeking an exit strategy. And one exit strategy could be selling the company to another one or conducting an initial public offering. It has a long-term horizon. That is a feature of private equity, long-term horizon. Next, risk and return. Risk and return. How is risk and return a feature of private equity? Now, private equity investments are considered higher risk, but potentially with high returns or rewards. So investors seek to achieve substantial returns by actively managing and growing the company in which they invest. Risk and return. Lastly, illiquid investment. Illiquid investment is yet another feature of private equity. Illiquid investment. Private equity investments are often illiquid. They are often what? They are often illiquid. Meaning that it may take several years before investors can exit and realize their return. And that contradicts or contrasts with publicly traded stocks which can be bought and sold more easily. So when one invests in a privately held company, that money is not easy to recover, or the stocks cannot be sold as easy as the stocks held by private, public companies. Illiquid investment. So these are 5 features. Let's now outline the advantages. The advantages, or let's call it pros. Remember, in this lesson, we are studying the pros, the features, the pros, and the cons. What are the advantages? What are the advantages of private equity? The first advantage is that one related to capital injection. Capital injection. Capital injection. Capital injection. What does that mean? Now, private equity provides significant capital injections into a company and thereby supporting the company's growth. By having these capital injections, that the company can easily grow, the company can expand, the company can have what we call strategic initiatives, and that is particularly valuable for businesses that are in need of substantial funding, capital injection. That's the first benefit. Strategic guidance. Strategic guidance. Strategic guidance. That is advantage number 2. Strategic guidance. Now, private equity firms bring expertise. Remember, we say that private equity is equity that is provided by private equity firms. This is capital that is provided by institutional investors to privately held companies, private companies. So these private equity firms, these institutional investors, they bring strategic guidance to the private companies. They bring expertise, they bring industry knowledge, they bring network of contacts to the companies they invest in, and that strategic guidance can then contribute to improved performance, can contribute to improved growth of the private companies. Strategic guidance. Operational improvements. Operational improvements. Operational improvements. This is another benefit. Operational improvement. Private equity investors often implement operational improvements, cost-cutting measures, and also efficiency enhancements to increase the profitability and also the value of the invested companies. Operational improvements. Alignment of interests. Alignment of interests. How is alignment of interest an advantage to or advantage associated with private equity? Now, private equity investors and company management often share aligned interests. Why? Because both parties benefit from the company's success. And this alignment can then foster a collaborative environment. It can foster a collaborative relationship between the private equity firms, the private equity investors, and the management of the private company. There is also potential for high returns. Potential for high returns. There is potential for high returns. Potential for high returns. Now, successful private equity investments, those that are successful. Successful private equity investments have the potential to deliver high returns, especially if the invested company experiences growth and successful exit. Then the investors are likely to generate high returns on their investment. So these are 5 benefits of private equity as a long-term source of funding. Next, we need to discuss is cons. What are the disadvantages of private equity? The first obvious advantage is loss of control. Loss of control. Loss of control. Remember, we say that when private equity investors pump their money in a private company, they gain ownership. and therefore the existing shareholders may lose control of the company. That may lead to dilution of ownership. The company founders and the existing management may experience loss of control. Why? Because private equity investors typically take substantial ownership of the company. Substantial ownership of the company. You understand? There may also be two exit challenges. Exit challenges. Exit challenges. Exit challenges. Exit challenges. Remember, we say that one feature of private equity is that it has a long-term horizon. Long-term horizon. And exiting a private equity investment can be challenging and may require specific market conditions, making it more difficult to realize returns within a desired time frame. Exit challenges. Short-term focus. Short-term focus. Short-term focus. How is short-term focus a disadvantage of private equity? Now, some critics have argued that private equity's emphasis on achieving short-term financial gains can sometimes lead to decisions that prioritize immediate profitability over long-term sustainability. It's obvious, it's normal for investors to want immediate profitability on their investment, and that can compromise the long-term sustainability of the company. Next, we have high costs. High costs. The costs associated with private equity transactions, including management fees, profit sharing arrangements, can relatively be high compared to other forms of financing. High costs. High costs. Then, lastly, we have what we call cultural misalignment. Cultural misalignment. Cultural misalignment. Cultural misalignment. These are simply differences in corporate culture and management style between the private equity investors and the existing management team, which may lead to conflicts, which may lead to challenges in implementing company policies. Cultural misalignment. These are differences in culture, differences in management styles between the founders and the private equity investors. So candidates, these are the benefits, the features, and the disadvantages of private equity. So we have identified 5 features. The first feature is equity investment. Number 2, active involvement. Long-term horizon. There is a feature related to risk and return and illiquid investment. We've outlined 5 benefits of private equity. One is capital injection. There's a benefit related to strategic guidance. We say that private equity firms bring strategic guidance, knowledge, skills to the company. They may also, number 3, bring operational improvements, which may lead to high profitability, saving on costs, and so on. Number 4, alignment of interests. Then there is a benefit related to high returns. Lastly, we've discussed the disadvantages of private equity. One is loss of control by the mere fact that the private equity investors may become shareholders in the company in which they invest in. Then the existing management, the existing shareholders may lose control of the company. Number 2, there are also exit challenges associated with private equity. There is a problem with the short-term focus. There are high costs associated with the private equity. And lastly, cultural misalignment. So these are 5 disadvantages, 5 benefits, and 5 features. Before we close the lesson, I'm going to read to you today's questions on private equity. Number 1, how does private equity financing differ from other forms of investment such as venture capital or public equity markets? And what types of companies are typically targeted by private equity firms? Number 2, explain the common strategies employed by private equity firms to create value in the companies they invest in, including operational improvements, mergers, and acquisitions. 3, what challenges and considerations do companies face when accepting private equity funding, and how does this form of financing impact the ownership structure and decision making within the company? Thank you for attending the lesson. In our next session, we are going to study asset securitization and sale as a long-term source of funds. Bye-bye.